Has sent commodities soaring over the last few months. Gold is near $1,100 today. Other commodities approaching 52-week highs. Let's get some insights on commodity investing. Join our Bob Pisani, who's got a couple of special guests. Bob.
Hello, Michelle. I'm here at IndexUniverses.com's Commodity Investing Conference. We want to talk about investing commodities in the dollar. Two of the big ETF experts are here. Tom Lydon's on my left over here. He's been around for a long time. Of course, he writes a well-known newsletter and a well-known blog site. And, of course, Matt Hogan is the head of IndexUniverse.com. He's basically in charge. He's the brains behind the operation. Let me just start with you, Tom. We've seen massive inflows into commodity ETFs this year. They didn't even exist 2 years ago. Now there's $80 billion in them. Is there some kind of bubble developing in commodities, and should people who want to invest in them be a little bit careful right now?
Well, you have to be careful. It has to be the right move for your asset class. However, there's a lot of people in this room behind us that are saying commodities are going to go a lot higher. And if that's the case, we as investors have to be careful and always have a stop loss in place. Make sure that if you're going to be riding this trend, use the 200-day moving average, for example, but don't over-allocate into certain areas.
Let me talk to you for a second. We have been talking about this dollar carry trade, the reflation trade, whatever you want to call it. Short the dollar, go long commodities, go long emerging markets. You can do this using exchange-traded funds. Show us how.
Sure, absolutely. There's an ETF, ticker is DBV, the PowerShares Currency Harvest Fund. It goes long, high-yielding currencies and short currencies paying low interest rates. It's an easy way for an individual investor to make an institutional caliber play on currency assets.
And that's what's striking about this is that is an excellent, simple way to play the carry trade. You're going to go long all of the Aussie, for example.
Absolutely.
You're going to go long the New Zealand dollar. You're going to go long all those currencies associated with commodities, and you're shorting essentially the U.S. dollar and the yen. And there it is right there. The symbol is DBV. Anything else, Tom? What else strikes you as a way to play this trade?
Well, the key is ETFs have arrived, and as far as commodities are concerned, 5 years ago, individual investors didn't have access. They do today in a whole variety of ways. However, as you point out, you have to be careful. We may see a bubble one day, but from a fundamental standpoint, it looks like commodities are going to be a lot higher 6 months from now.
My colleague Michelle has a question. Yes, Michelle?
Does either one of the guests have any answers? We're going to solve this problem when it comes to some of these commodity ETFs. The rollover is so expensive that you actually have to have a huge move in that underlying commodity to actually make money as an individual?
She wants to, did you hear the question?
Absolutely.
Go ahead.
I think that's a great point. I mean, you've seen something like the GSCI commodity index on a spot basis go up huge this year, 45%, but an investor in that index, because of that roll problem, is only up 5 to 10%. There are some ETFs that take a long-short position. LSC is one of them. There's some that play a smarter play on the commodity curve, like DBC, so we're innovating around that, but that's absolutely something people should be aware of.
I'm a big backer of ETFs, both of you know that, but I'm very concerned here about trend following versus a proper asset allocation model. How much should someone own in a reasonable portfolio of its basic materials or gold itself versus just being a trend follower? What's the distinction?
Well, historically, there was a 5 to 7% allocation, but old, asset allocation models that we had in the last 10 years, many people are throwing them out the window based on the economic environment today. So I think it's safe to have a 10 to 15% allocation based on today's environment. But the key is, as you know, when something gets hot, a lot of money flows that way. That's the reason why we want to talk about some type of technical overlay to protect you when that bubble may be bursting.
Yeah, Bill's getting in here too as well, Bill.
Having said that, though, Tom, I remember in the early 90s when much was made of the fact that at that time, there were more mutual funds than there were stocks trading on the New York Stock Exchange. I don't know if we're there yet with ETFs, but there are an awful lot of ETFs coming out right now. Are we getting to the point where we're reaching that critical point where there are too many ETFs and we'll have too many people buying too few stocks or commodities? They're buying the derivatives instead.
Well, Bill, right now, ETFs only represent about 6% of overall mutual fund assets. And sure enough, there are a decent amount of choices in the commodity space, but it's not overwhelming. I think there's a nice, and Matt, help me out here. I mean, we're not overwhelmed with commodity choices in ETFs.
We're not there yet, but could we get there? I mean, look, you guys are selling them hard. A lot of people are. I don't fault you for that. I think it's an efficient way to invest, but at some point we're going to overdo it, aren't we?
I think the risk is more that you've seen an explosion in these sort of niche market ETFs, which are important and can be good portfolio diversifiers, but you don't want them to be the bulk of your portfolio. So you don't want investors putting 30, 40% in these tiny, narrow sectors, but they can start with a broader market ETFs and then fill in around the edges with these other ones.
Apropos of what Bill was just saying, Charles Schwab just this week announced a whole new series of ETFs. They're plain vanilla. They're not that exciting, but here's what's interesting about them. No commissions. Bill, $20 it was for most, brokerages to do to buy into ETFs. No commissions if you have a Schwab account there. That's going to make it a lot easier for people to invest on a dollar averaging basis. Could this be the wave of the future now?
I think it's a huge move. I mean, I think if you're an investor, you can now buy an ETF, fully tax efficient, extremely low cost. We're talking 8 basis points with no commissions. You can dollar cost average into it. I think we're going to see ETF assets double or triple as this sort of trend takes hold.
And once you get the 401ks, once that dam bursts, then you're going to see real movement.
Absolutely.
Right, and that'll happen.
Okay. Tom Lydon, Matt Hogan, pleasure to see you. Thanks very much.
Thanks.